This is Steve Wells.
And I'm Jeffrey Feldberg. Welcome to the Sell My Business podcast.
This podcast is brought to you by Deep Wealth. Are you a business owner who's wondering how to either grow your business, sell it, or both? Or maybe in today's environment, you're wondering how to make your business pandemic proof. Visit deepwealth.com to find out how you can master the strategies to grow and extract the deep wealth from your business. Visit www.deepwealth.com.
Today, it's terrific to have Ed LeMasters with us. Ed's been in the financial services industry for over 35 years and is a wealth advisor and portfolio manager. Ed has extensive training in estate planning and wealth management. Ed's team manages a diversified base of clients that varies from wealthy families to institutions, foundations, private schools, associations, and corporations.
You know, Jeffrey, I think Ed must be a very important person. We have a disclaimer to read from his legal department since Ed's not allowed to mention his firm. So here goes. This interview is for the express purpose of discussing general business principles and is not meant to convey investment advice, promote any firm, product, service, or individual. All information and opinions expressed are just that and pertain to the current environment and are subject to change. Well, Ed, welcome, and thank you so much for being with us today. I know that you are an expert in helping businesses before they exit to prepare for the infusion of cash that they're going to get, and then after they exit, what to do with that. We're going to reserve that topic for another time because right now we want to address the financial issues that we're having with this pandemic crisis. And I know you have a lot of insight that you could give our listeners, but why don't you give us a brief overview of what you have been doing and do and what type of clients that you're seeing?
Sure. I've been in the investment business for 37 years for one of the largest banks in the world. 55% of my clients have retired. Of those, about half were business owners that have exited their business, and the remaining 45%, about half of those are currently running a business. So they're living through this pandemic as we speak. And then the other half of that 45% are professionals, cardiologists, surgeons, doctors groups, and some large associations. So really have dealt with business owners for 37 years and have walked 30-year-olds who are now in their 60s all the way through the investing life cycle, all the way to fruition and exit.
Well, great. With your clients that you see, Ed, what are you noticing? I mean, you've got a wide variety of businesses and professionals. I mean, what are you seeing their lives and businesses are being affected, and how are they surviving or trying to survive during this time?
That's a great question. I think it is survival mode, dealing with one of the most unusual unknowns that we've ever run into. We don't know when it's going to end. We don't know when the government's going to reopen. So everybody is literally staying glued to the data to see how quickly they can come out. I've seen clients access lines of credit, obviously get their payroll together and apply for this PPP and take advantage of the government programs that are out there. I would say the biggest thing in a deeper conversation, in a deeper context, when your business gets stressed, everything becomes clear. When business is great, a lot of weaknesses in your business easy to look over and be hidden. But this kind of lays bare anything that you need to change in your business on a go-forward basis. Do you have too many people? How are people adapting to working at home? Were you prepared in any way, shape, or form for a 50% drop in revenues, 30% drop in revenues? How quickly can your organization adapt when something from left field comes at? On a deeper level, business people are really examining their business from top to bottom so that they know they can identify what needs to be changed on the other side.
Ed, I really like what you said just now, that when your business becomes stressed, that's when everything becomes clear. And there's a lot of wisdom in that. But let me ask you this. I think most people would agree that the pandemic caught everyone off guard. But suppose we somehow could go back in time, and it's 2 years ago, And 2 years ago, we said in 2 years from now, there's going to be a pandemic that's going to hit the entire world like we've never seen before. What advice would you be saying 2 years ago to the business owner, both on the business side and on the personal side, to prepare yourself on the financial sense for a pandemic-like situation that we're currently going through? What strategies could be done?
Yeah, that's a great question. Let me use contractors, builders as an example, because we deal with many large general contractors, subcontractors, $100 million companies in the construction business. And as a continuum, you've got the contractor who says, my business is cyclical. There really is no repeat business. I've got to go out and find new projects and rebid things every year. So I want to have a portfolio that's not tied to the economic cycle. And that might be bonds or something conservative. There's the other side who says, there's so much money being made in construction. I'm dealing with people in real estate, and I'm going to take my excess earnings and I'm going to become a apartment complex owner. And so they take their expertise and they decide to become a developer or use their contracting skills to build a business. When '08 happened, which is the last time I really saw a big crisis like this, business went down for these contractors. $100 million companies went to 80, 50, $20 million in a matter of 2 years. Business and construction stopped. So in that case, that builder who had a portfolio of bond stocks, whatever, survived in our market if some of the biggest contractors went under in '08, '09. So I think that we don't know what the next pandemic, war, disease, or business climate change will look like. So I think having that portfolio that's not tied to your business is really important, especially if you're in a cyclical business like construction, or if you're in a business like technology, which can rapidly change over a 4 or 5 year period.
So I guess if I hear you correctly, just as if you're developing a stock portfolio, you want diversification and you want things that aren't as related. So you can do that in a business. What about reserves? We've talked to some nonprofits who really, because of their board of directors and maybe their bylaws, said they could not have reserves. Now they wish they had reserves. Have you seen anything, in personal or business life that would
on the business side, one of the things we run into with an entrepreneur is, I don't need anything else. My business is my stock. I'm going to build this company and at some point exit, and then I'll have this pot of gold. And why should I invest in tax-free bonds or equities when I can produce widgets and I've got a 20%, pre-tax profit margin? And you're wanting me to take money out of that 20% operating profit margin and put it into bonds or stocks that yield 5 or 10%. If I can convince them that you need to have something that's not tied to your business, not tied to the economic cycle, is not going to go up or down when your revenues go up or down, and convince them to diversify, that's really a survival tactic. And we can see it. We can see it in the public markets and the private markets, where companies that don't build up that reserve, and I don't have a percentage number that you should have, but a number that certainly can support you for 90 to 120 days with zero revenue would be a reserve that I think after this panic, a lot of business people will be shooting for. And they didn't feel like they needed that, to Jeffrey's previous question, 60 days ago.
And you bring up some interesting points. So I know at Deep Wealth, when we speak to business owners who are contemplating either to grow their business or to sell their business or both, one of the common things that we hear is, I don't need any help. I don't want to pay any commissions. I don't need an investment banker. I don't even need a broker. I'll just do it on my own. And I also hear the same thing, the same kind of thinking from business owners. Well, you know what? I don't really play the markets, but if I did, or if I do play the markets, I'll just do it online. Why pay the commission? I can do it myself. I'm a pretty smart guy. I look at the business that I've built.
Right.
And the three of us all know that that is just a path that puts you on danger, that has a destination called destruction. What would you say to our listeners who have that kind of thinking of why a professional like yourself should be involved with the business owner as early as possible to do what you do?
That's a great question. And entrepreneurs, business owners can be your best clients, and it can be also your most challenging prospects. Tend to be self-confident, type A, driven, goal-oriented, and in some cases, very much in control of their life, their destiny, their businesses. So it's very hard for some people to give up that control. So I would say to them, you have a CPA, you have a CFO, you have tax experts, you have attorneys, and you want to be involved in all those areas of your business, but you don't want to draw up the legal contract and you use a professional. We're that objective person that can really guide them into a pretty complex world of not only investments, but currencies, hedge funds, bonds, interest rates, in places that they're not an expert. So I try to tell them that you're an expert at widgets, we're an expert at the market. Let's work together. And over time, you will become more and more educated on the business. I also encourage clients, if they want to have their play account at E-Trade or a discount broker, go ahead and do it yourself. And let's come back in 2 years and compare, our results of what we've built as a portfolio together versus your stock picking hobby. And I've never lost that bet. I might lose that bet in the future, but I haven't lost that bet. So I would say you're used to employing experts, employ us and give us an opportunity to show you a different set of examples.
Even if it's not an entrepreneur, maybe even you're in the medical profession. I mean, you're a surgeon, who knows what, you're doing something. Do you find psychologically the idea of having really a passive investment, one that you're not controlling, that now you are controlling for them? Is that a tough thing for some people to get their head around?
Absolutely. And in light of the pandemic, with the market that's actually acted very emotionally the last couple months, and some days has gone down, up on bad news and gone down on good news, it makes those same clients feel like it's completely out of their control. As Warren Buffett says, in the short term, the market is an emotional barometer. In the long term, it's a calculator. If you can get people to get out of the day-to-day emotions of what's going on today and look out 2 years, they feel more comfortable. It's really important to get them into a long-term plan, focus on a year, 2, 3 years down the road, show them historical returns. That the market always seems to come back to think more about investments in the long term, like they plan for their business 3 and 5 years out.
Ed, I'm wondering if we put ourselves in the place of many people out there who, if they've invested in the market, they've seen a very large reduction in what the value of the portfolio is compared to what it was just a very short while back. And so let's assume that they haven't panicked and they didn't do anything just yet. And unfortunately for a lot of people, that may not be the case. Mm-hmm. But if you're someone who watched your portfolio go down 10, 20, 30, 40%, maybe more, and you're wondering what to do right now, and things can change, but right now, and really in any pandemic, what's your advice to the business owner on the personal side, but also on the business side of what do you do? On paper, you're underwater in a big way.
It's obviously much easier to react and make some changes in the public market. You can't really do that with your business overnight. But in a panic situation like we saw in March, where emotions rule, we tell people panic is not an investment strategy. You need to really calm down. It's very tough because people start They may not watch their account every month when it's going up, but when it's going down, they tend to log on and start checking it, day to day. So I would say to them, we didn't buy these things to make money in June or July of this year. We bought them to build wealth over time. And I like to use the time correction. So let me put that in perspective. In 2008, the market pulled back 50%. And we went back 12 years in time. So in '08, at the bottom, the market went back to where it was in 1996. That's a serious correction. That's a real damage to your permanent wealth. It's going to take a couple, 2, 3, 4 years to come back. This correction, just to put it in perspective, has basically, last year was a great year in the market. This year's been tough, and you've given back 1 year's of gains. A 60-40 account is back to where it was about last January. So you've stepped back in time about 15 months versus 12 years in 2008. So project out 2 years, this pandemic will be over. We may have a vaccine, but you look 2 years out and you would say to a client, this market is going to be much higher than it is today. May not be back at, say, 30,000 on the Dow, but we'll be out of this pandemic, and the market and the business environment will be recovering. So you can rest assured it'll be higher 2 years out. When you look at every war, pandemic, World War II, 1957 flu that caused a 30% correction in the market, you go out 2 years and you were very profitable.
So, I know there are people who might look for opportunities. Do you think there will be opportunities for people, and what can they do? How can they see those, or you would help them see them? But
great question. There already are, and it's interesting that doctors who have a low beta, right? They have a pretty steady job. Doctors are never unemployed. They don't get fired. They're interested right now, and they're asking questions about, should I buy X? Should I buy Y? It's the business owner that's just furloughed 50 people, applied for a government program, hasn't gotten their check yet, and is hemorrhaging, $20 or $50 or $100,000 a week in payroll, that is not ready to buy stocks. And intuitively, he may know there's opportunities out there, but the business climate is just so bad. I also think that there's a huge difference between the doctor and the professional, just as far as their outlook on the world. And we have to remember that we are all biased. So whatever you're going through in your personal life, with your family, with your business, colors your view of the market, the economy. And I have to constantly remind clients of that, because they're really two different things. But you do bring your biases to the table. And I would say business people just today are very nervous and are probably more pessimistic about the length of this pandemic and how long it's going to take their business to recover.
Ed, I'm going to ask a loaded question, and the reality is no one really knows. And hindsight's always 2020.
Sure.
Looking back now, whether it was the coronavirus or something else, were there telltale signs that heading into, call it February, March, that you just knew something wasn't right, and you didn't know when, but it was just a matter of it's going to happen?
Yeah. So whenever the market trades above 18 times current year number, and it happens a lot. I mean, about 30% of the time, the market's up around 17 or 18. What that tells you is the market's priced to perfection. It's priced in lower rates. It's priced in the president at the time. It's priced in geopolitical peace. It's priced in this case, this year, earnings growth of 7, 8, 9% on the S&P 500. And so you get this, I won't call it a bubble, that inflated level. Anything that goes wrong that breaks those hypotheses or those things that are baked into the cake will typically lead to a 10 or 15% correction. And that's when you get these violent corrections. This one was 30% because, to your point, it came out of left field. It happened in a period of, we kind of discovered that this was going to spread across the country in a very short period of time, and led to one of the quickest record highs to a 20% correction in 8 trading days. That was unprecedented. So the speed at which this happened was really something. I would say to the business owner, and again, this isn't about exit, but the timing of when you sell your business is really, really important. Clearly, if somebody was going to exit their business, the time to do it was last year when private equity were making cold calls and valuations were at the all-time high. A business that didn't exit last October may not see that valuation till this whole thing is over. It may take them 2 years to get there. So I just wanted to include that because I know some of your listeners are looking down the road. And I think you have to look at a good economy and a good stock market for what it is and factor that into your decision on when and where you exit.
You bring up a point that we talk about at Deep Wealth all the time, is that you want to grow your business and maybe you want to exit the business, but they're compatible with having a business that's ready. And so a lot of the things that we advise people to do is preparing themselves so that when opportunity comes, they can take advantage of it, because a lot of this stuff takes time. It takes time to get your management team. It takes time to readjust your business model. So you have a balanced portfolio where you're going to balance, how much equity, how much bonds, everything else. And the reason for that is for the strategy that you've allocated. So when you see a hot economy and you rebalance and you give yourself some leeway, I think you probably did that. You probably put cash, took some equity off the table to make sure they're in balance, but also maybe a little bit more when you saw the economy being pretty hot.
I'm going to touch on that and just address kind of the mindset of a business owner. So, thinking of people, a dozen clients that I've had as clients since the 80s and 90s and watch their kids grow up and watch them build their business and then walk through the sale of their business. And then they got this pot of gold at the end of the tunnel. The mindset of somebody that has a business and then maybe has a $500,000 or $1 million in non-business savings, deferred comp plan is very different than when they exit and they have the most money they're probably ever going to have at one time, be it 10 million, 20 million, 50 million, 100 million. The mindset becomes, I've made my money, I've built my empire, I don't want to lose this. So we find that person who might have been a risk taker, might have been a serial entrepreneur, might have exited, built and sold multiple businesses, says, you know what? At this point, I want to give back. I want to take care of my family. And those portfolios, we see these portfolios typically 15, 20, 30, 35% in equities and the remainder of their portfolio in non-correlated, fairly safe stuff, whether it be hedged funds or whether it be tax-free municipal bonds. So I can say with a high degree of confidence in the last 90 days, when the market was down 30, that type of client might have been down 10, 11% in a down 30 market. And so that's where we really bring an expertise to the table and can help them build, quote, that bulletproof portfolio. Because at 10 or 20 or 30 or 50 million, you're not typically trying to triple that again. You just don't want to go back at age 60 or 70 and have to do it all over again and suffer a loss of 20, 30, 40, 50%. So I hope that answered your question, but there's a real mindset upon an exit that we see a change in the risk tolerance that usually it correlates with age too. Somebody exiting it at 40 may have a different attitude, may want to double it again, but somebody exiting at 55 or 65 just doesn't need the hassle.
Ed, let me pick up on what you were saying with mindset. And If I'm looking for a financial advisor, it doesn't matter if I've sold my company or if I'm
Mhm.
growing my company. I imagine that there's certain attributes that are going to stand out and are going to be the order winners of what I want for someone who's
Yeah,
going to represent my interests and my hard earned money. Because today it's information is so much information is free and is easily
right.
accessible. I would imagine, though, that the saying you get what you pay for applies here. So, for a community who find themselves in a
Mhm.
situation that they don't like and would like to change that and are now out there wondering or thinking about who could I look to take my money and invest it and get some decent returns regardless of what's going on and to protect it, what would be the attributes of a person like yourself, of a financial advisor, a wealth manager?
Great question. I think number one is you have to find somebody that you're going to like and trust because it's going to be one of your closest relationships, maybe not day one or two or three, but over a 5, 10, 20-year period. That person is going to be one of the closest relationships you have in your life. So you have to like them and respect them. I would also say you want somebody that's not so rigid that they come across as that they know everything there is to know, because this is a business where you have to constantly be learning, constantly be adapting to changing situations. The last 90 days a perfect example. And so again, I think you have to find somebody that you're on the same page with, has your best interest in mind, that you feel like you like and trust. And then, the things you would look for if you were hiring somebody would come into play: hard work, dedication, going the extra mile, the same things you would want in a star employee, you would look for in an advisor. And when somebody goes to exit, and a lot of times we're talking to business owners that aren't clients, knowing that they may exit in the next 3 or 4 years, and positioning ourselves as wanting to be there, we encourage them to go interview 2 or 3 other people. We think we will shine if you go look at the competition. So I mean, we throw that out there at the events that we do for business owners. Interview 3 or 4. We feel like we will win more than we lose if you do that.
Money it's such an important part of everybody's life, and so when you are involved in that, you are intimate with those businesses and those families. So I hear what you're saying, because you're going to be there at every wedding, baby, college fund, to funeral, to, I mean, all those things are impacted by money.
It's even deeper than that. Two best friends from high school, known each other for 40 years. They may have never talked about finances ever. Shared like where they spend too much, or I'm really thinking about what I should do. What's my legacy? They don't have that deep conversation, especially men. So if someone has that conversation with their financial advisor, and their financial advisor truly knows their whole financial situation and has done a plan, there's a level of intimacy there that he may have with his advisor that his 3 best social friends have no clue about what's really going on in his financial world. So it tends to bring that intimacy to the relationship. And a lot of times the first guy that a client calls when there's problems in a marriage or problems with a child. So I think that just comes with the territory.
Ed, I often hear when it comes to financial advisors, I hear the term past results don't predict future ones. And so when you hear that, and if I were to speak to different advisors, I would imagine most advisors, of course, they're going to say, hey, Jeffrey, I work really hard for you and I have experience and I've been in the industry and I'll work with you. I'm flexible. Many of the attributes that you had shared of what to look for. So, what's the BS test out there? Is there, in your
Yeah,
experience,
it's a great question.
how do you really know that you get beyond the talk and the sales talk and the marketing talk? Are there any 1, 2, or 3 telltale signs that this is a wealth manager or financial advisor that's worth considering?
That's a great question. Yes. So one of the key questions I would want to ask is, how much money do you personally manage? Not your 5-person team, but do you personally manage? And how many families is that? The average financial advisor in America has about 350 to 400 clients, which means they literally are spending all their time with 20 or 30 families and the rest are getting ignored. So you want somebody that has a lot of assets, but not a lot of relationships, 20 families, 30 families, 40 families. The other thing is, we say this at our events, we deal with business owners. We deal with business owners who have sold. We walk clients through that life cycle. And we'd love to have you. We will introduce you to some of our existing clients if you were serious and you were, really want to get down and dirty and interview us. I think that if you're dealing with somebody that's going to sell their business and they're going to sell for a substantial amount of money, asking the advisor to say, I'd love to meet a couple of your clients that are similar to me, that have walked this path, exited their business. Any good advisor should be able to put one of his favorite clients in front of you and let you tell them what the relationship's been like.
We're starting to wrap this up, Ed, and you can't really predict anything. I know it's changing day to day, but have you been reading anything or seeing anything about, how you think this might affect consumer behavior? I mean, what are some of the big minds say about this?
Absolutely. So early on, and it could still be wrong, I've seen pieces from Goldman, UBS, JP Morgan, a lot of the big firms writing about what will happen. And knowing the pain that I was hearing from clients and friends and social contacts, I didn't buy into the V. I still don't buy into the V-like correction, like we're going to be back to normal in August and everything's going to be great and unemployment's going to be 3.8%. There's kind of the U-shaped recovery where we're gonna have a bottoming process and then kind of grind out of this, hopefully in 6, 8, 9, 10 months by first quarter next year is what I've been telling clients. And then there's the L-shaped recovery where we go down and we stay down for a long time. That's almost like heavy, terrible depression, recession that lasts for a couple years. So, looking at the U-shape recovery, it's going to be very much a stock picker's market. And what do I mean by that? It means the S&P 500 is not going to go back to 3,400 from today's 2,700. There's going to be winners, huge losers. And it's time to really figure out, where you want to be invested, or if you're picking managers, where that manager is going to be invested. Because I just don't see the hotel and airline business coming out of this right away. And yet yesterday, as we were preparing for this, Amazon hit its all-time high. So tech stocks that have secular growth of 20%, low debt, an employee workforce that can work from home, high cash flow, high barriers to entry, those companies, be it Netflix or Amazon, are doing well. Where, Hilton might go out of business. JCPenney went out of business this week. Retail was in bad shape before this happened, and it's probably going to get worse. So, it's a time where you can't just sit back on your investments or your business. It's really time to dig in. What I'm hearing from a lot of business owner clients is they've laid some people off and they've figured out that they can operate with less people. And they're not going to probably snap back and just hire those same people back. They realize that who they need and who they're going to keep. And they realize there was probably some fluff in there and dead wood, and they're getting rid of it.
And I'm wondering, as we start to close things out here, is a mindset of managing your wealth during a pandemic when it comes to investing, is it any different than regular times or not? So in other words, yes, it's crazy out there and perhaps you're looking at different opportunities or not. But from a strategic side, from a mindset side, does it really make a difference from all the years that you've been doing this?
Yeah, the best investors, and I hope that every client we have over a 4, 5, 10-year period becomes a better investor, learns that you got to control your emotions. And Steve made a point earlier, rebalancing is important. So you have 30% in equities. Last year, the equities went way up at the beginning of the year. That 30% is now 35%. And as a matter of practice, you take profits, pull that 35% in equities back to 30. And so you take risk off the table in January, even though things looked very bright. Similarly, if you had 30% in equities 90 days ago and that 30% now is down to 25%, having the discipline to then add money to your equity portfolio to bring it back to your target of 30% is really important. So I think you have to, use the old rule. When everybody is giddy and buying, you got to trim and pull a little bit off the table. And when everybody is panicking and there's blood in the streets and nobody wants to buy, you have to have the intestinal fortitude to go against the crowd and buy. And that will probably never change.
Ed, one of the questions that we like to ask as we begin to wrap things up here is, with your nearly 4 decades of experience and knowing what you know, if you could do only one thing, what would that be on the investment side?
I would say stick with high quality. And if that means picking a manager or a fund, or if that means building a portfolio around stocks, quality always wins out. When you read the news today, you're not hearing, tales of death on companies like Procter and Gamble or Johnson and Johnson or Costco. You're hearing death of Hilton and Macy's, companies that were having problems way before this. So quality matters. A lot of people have gotten burned in high yield bonds. And again, quality, if something is yielding 13% and treasuries are yielding less than 1%, you got to say there's something wrong. Biting into junk bonds or high yield debt or something that sounds too good to be true. If you do that long enough, you're going to get burned. So I think quality rules in our game and always will.
I guess kind of it's that greed, isn't it? It's kind of a human nature. You look at something and say, wow, it'd be great if I could make that. But, there's a reason that comes with a lot of risk.
I would just say sticking with a thesis, even when the fact set changes, it hurts business people. It hurts in the market. So quick story. Got a client that cleans a university, cleans office buildings downtown, has the #1 window cleaning company. He's looking at it, 370 employees, and he's saying our world has changed forever because, first of all, companies in these downtown office buildings are figuring out that 30% of their people can work from home. So they're going to cut back on office space. And then they literally want, like every surface wiped down every day. So he's looking at it and saying, what do I have to do to adapt to comply with the need to sterilize basically their workplace every night? Also knowing that a lot of these big companies are going to cut back on their square foot office space, which is how they pay us, by 20 or 30% in the next few years. So he's adapting now before the change takes place. And, that's an example of, I think, what every business person's got to be doing right now.
Well, as we wrap it up, any final words of advice you have for our listeners?
I think the last thing I would say is just you should have a plan. That plan should have been in place the last few years. You should have numbers of where you ought to be in 3, 4, 5, 6 years down the road. And this is the time to pull out that plan that you did in 2016 or 18, dust it off, and you're probably going to see that you're right about where you thought you would be, even at today's number, back in 14 or 15, because the market, to Jeffrey's earlier point, went up probably farther than it should have last year, was at some extreme valuations. And now it's just given back a little bit of the profit of the last year, let alone not even a debt in the plan, considering what the markets have done the last 10 years. So focus on the longer term with your business and with your portfolio. That'd be my last tidbit.
Terrific. Ed, I've enjoyed your insights and your wisdom. You bring a wealth of experience. Thank you.
Thank you for the opportunity. It's been a lot of fun.
Thanks, Ed.